So from an importer's point of view, it can really help them expand their business, because you probably find a lot of your commercial customers might come through to you and say, look, I really do need to fund these additional purchase orders. Can I get some more money from a house? Now, clearly, if we can avoid that sort of issue, it helps to de-risk your individual client customer. So let's have a quick look at an example. I just want you to think of the idea that your client has actually got 200 grand's worth of capital available to actually import products, working on the basis that the working capital cycle is about 100 days. In other words, where they have to pay 30% up front and 70% once the goods are on the ship. We'll work on the basis that the sales markup is 100%. In other words, their gross margins are 50%. I don't want to get too heavily involved in a lot of the technical stuff, other than let's just keep it simple. The goods are marked up by 100%. And that they have to actually pay 30% deposit and 70% on the goods being shipped. So we'll just show a quick example to keep it really simple. In this particular situation, without inventory finance, the capital available is 200 grand. So what happens is your client puts down 30% deposit initially, and then when the goods are on the boat, they put the 140 grand as the balancing amount. The goods actually arrive in Australia, 200 grams worth of goods. They then sell them for 400 grand. So the overall profit, as we can see, is 200 grand. Let's have a look at it in relation to inventory finance. So the idea is the capital available, which is the cash that your client's already got, if they use that as the 30% deposit, then providing they've actually got purchase orders to actually cover the product that's being bought, the inventory financier can actually pay the 70% balance themselves, so as a debt facility. So what that means is, if you add those two together, the 200 grand and the 467, it actually gives the total imported product is about 667, and with the 100% markup in sales, that gives sales value of 1.3 million, and the profit that they make, obviously this is before overheads and that type of thing, is 667,000. So if they've actually got the purchase orders in place, they're going to make a lot more profit if they can actually get access to the inventory finance. So that's where the benefit really comes in terms of when you look at the advantages of inventory finance. The key thing is that they can get increased sales. All right, and not having to actually put additional cash in. Next area is you get increased gross profitability. They get increased money coming in, increased profitability. Now that can actually be associated also through increased economies of scale, because if they're actually buying more product, they can actually get discounts and that type of thing. So if they have access to additional cash, it actually means that they can grow their business more profitably. Now, the other side is that for established businesses, and I do stress established businesses, real estate security is generally not required. If it's an early stage business, that's a different area, but and we'll come on to these sort of areas in a second. So let's have a quick look at a couple of the disadvantages of inventory finance. Clearly there are increased costs, but the reality is that those can easily be offset by the gross profit or the additional profit that they make. In general terms, there will almost always be a fixed and floating charge that is put in place over the business. So it does increase the risk from the business perspective that if they don't perform their particular contracts well, it could be the situation that the lender, in theory, could appoint a receiver. But clearly no lender wants to actually appoint a receiver because they're going to have to get their money back out of the inventory, which we highlighted earlier on as high risk. The other issue, as I said earlier, is that it's tough credit criteria. It's not available to all companies. The business has to be profitable. In general terms, inventory finance will not be available for companies that are not making money. It's not actually suited, for example, to Aussie manufacturers where they have to add value to the product. So, for example, if you've got a company that's a plastic injection molder making, I don't know, shampoo bottles, for example, it's not the situation. The inventory financier, in general, will cover the purchase of raw materials. There are a couple that can, but I don't propose to get too heavily involved in that, but it's generally not suited to those that have to add value in the process. It's really about if they're importing product and shipping it through to the end customers. That's where inventory finance comes through. It's not really suited for straight retail businesses. Again, there are exceptions, but in general terms, retail is very tough on the inventory finance side. There are some exceptions, but it's generally not suited to straight retail in this particular idea with the purchase order finance. So I don't know if there are any quick questions that anybody has just whilst we're moving along.
Yeah, we've got one from Madan. If anybody else has got any questions, if you want to pop them through now. Madan has just asked, what percentage will be financed of the import value?
Basically, what will happen if the end client has got at least 80% purchase orders. So in other words, if DJs or Maya have actually given them purchase orders, if they've got in excess of 80% purchase orders, then the inventory financier will fund the entire container. If they have less orders than 80%, then the client will be expected to chip in some money. So in general terms, they can fund 100% of the containers being brought in if there are purchase orders at the back end.
Great. Okay. Thanks, Tim. I think we need to push on, if that's okay.
Okay, no problems.
Cool.
Okay, so just moving quickly on. There's, that was the screen that we used a moment ago, just to actually highlight where the facility would really work well for a company with looking at purchase order finance. I want to look at the next slide, which I actually called inventory finance on steroids. And the way that this works is that if you actually link it in to a factoring facility, and this is something that is really, it's a fantastic facility. If you link it into the factoring facility, what actually happens is, once the product actually arrived in Australia and is shipped to the customer, client actually factors the invoice up front. And the idea is that 85% of that cash of the invoice value is made available up front. Now, if you can actually repay the inventory finance facility at that point, then what it means is that the inventory financier will then make available more cash for you to actually go out and buy more product. So the idea is that once the invoices have actually been raised and the invoice is factored, then 85% comes up front, repays the inventory finance, which means they go out and buy more product. Now, when the customer actually pays, the remaining 15% comes back to the client company. So by combining those two facilities, it can actually expand a client company's business phenomenally. And we've seen that successfully with a number of the clients that we've actually been working with, where we've structured both inventory finance and factory facilities together, and it works incredibly well to actually enable them to expand their business markedly. Now let's just have a quick look at some of the key criteria. If the businesses really have to have been in business for at least 2 years with track record and profitable businesses. Now, for those that are less than 2 years, they can be looked at, but in general terms, we would need to put a factoring facility at the back end, and real estate security may be required. I do stress may. It might be in the form of an unregistered caveat or something along those lines. But in general terms, for companies with little track record, it does become difficult without good quality management and the possibility of real estate security. The businesses have to be profitable. They will not fund businesses that are unprofitable. Again, if it's an early stage company and the quality of the management is very high, that might work. But again, I mean, if in doubt, just get in touch with us and we'll try and guide you through that. The other area is there's got to be a high percentage of pre-sold imported stock. The inventory financier does not want to be left holding a load of stock that it can't get rid of. And that's the biggest risk from their point of view. If they've got good quality, confirmed purchase orders from good quality customers, that's what they really tend to like. We also need to have good gross margins. Generally speaking, because they require normally 80% purchase orders in place, you generally need to have at least 20% margins. Now, if importers and distributors generally work on 40, 45, 50% gross margins, but in general terms, they've got to have high gross margins. And the inventory has to be saleable. If things all turned nasty, at the end of the day, the financier has to get rid of that stock, and it wants to try and sell it to customers that can actually buy it. So that's going to be an important issue. So things like specialized inventory with little resale value or high fashion are very, very hard to finance.